Welcome to this video on tax loss harvesting. So what is it? Tax loss harvesting is a tool to reduce taxable gains in a portfolio. And this is typically something that you will want to look at in December before the end of the year. There are some required conditions. First, be working in a non-tax advantaged account. So no IRA or 401k or that sort of account. Also, you have to have had realized gains this year. Those are the ones you're trying to get rid of. And you have to have unrealized losses that you're willing to close this year. And this is what will offset those gains. So why do it? The goal is to reduce or even eliminate your taxable investment income. This will reduce your tax bill. And you really want to reduce your short-term gains as much as possible. Short-term gains are taxed as regular income, and that's likely your highest bracket. Long-term gains are taxed at a separate rate, depending on your income. So how do you do it? If you have a diversified portfolio, you probably have some winners and some losers. And here is where those losers can help you out. Having identified that you meet the conditions, detailed just before, you need to pick the investments to close. Ideally, you want to completely wipe out your gains on paper. You can even claim a net tax loss of up to $3,000. This means that the loss you generate can be bigger than the gain you're trying to cancel out. If your net loss ends up being greater than $3,000, that's okay, as you can carry it over to the next year. So you close the positions. Most likely this will be selling stock. Some stock that you bought and it's worth less than what you paid for now. But it could also be closing a short position. You sold something thinking it would go down and you could buy it for less, but instead it went up. And now you would have to buy it back for more, and that's a loss. Rolling a deep in the money covered call is another good way to generate a loss. Beware of the trap of closing a losing position and then opening it up again right away. This will result in what the IRS calls a wash sale, and you definitely want to avoid that. The wash sale rule. IRS Publication 550 states, wash sale. A sale of stock or securities at a loss within 30 days before or after you buy or acquire in a fully taxable trade or acquire a contract or option to buy substantially identical stocks or securities. This means that you can't sell a losing stock holding and then buy it back within 30 days just to book the loss, but then keep your position. You can do so on the 31st day, but not before. This applies globally and not just in the same account. You can't sell it in one account and then sneakily buy it back in a different account. Even if that other account is a tax advantage account, you still cannot do that. You also can't try to game the system by increasing your position first and then selling the stock. As always check with your advisors when doing this sort of thing. So let's work through an example. Let's say you have a realized gain of $5,000 in a taxable account. Your current holdings are 100 shares of ABC stock with a cost basis of $6,000 that are now worth $3,000. So you're sitting on an unrealized loss of $3,000. You also have 100 shares of DEF stock with a cost basis of $2,000 that are now worth $8,000. That's generally what you like to see. You have an unrealized gain of $6,000. That's not going to help you right now. But you sold a short call, so you have one short $50 call on DEF stock with a cost basis of $200. So you received $200. Clearly, with the stock price at 80 in this case, that call is worth a lot more. So you would have to buy it back or sell the shares. Let's say you buy back the short call of DEF, costs you about $3,000. And as a parenthesis, let's just say you sell another further expiration $60 call. This may even be possible for net positive cash flow. But the main point is that it generates a realized loss of $3,000 minus $200, which is $2,800. Since $2,800 is not as much as $5,000, you can still do more. You sell the ABC stock for $3,000, and that generates another realized loss of $3,000 because you only got back half your money. This brings the total to $5,800, which covers the whole gain and reduces your taxable income by $800. If there were other positions, you could convert $5,000 of income to a $3,000 reduction of income, and that's an $8,000 swing in your taxable income. And that's really what we're trying to do here. Let's look at some tax scenarios. The first one is when you have a gain. All of this gain is going to go into your taxable income. If you can generate some losses, you will reduce the taxable income to the amount above the line. So that's already a good step forward. If you can generate losses that are greater than your gains, you have a taxable loss that will reduce your other taxable income. And if that net loss is greater than $3,000, your tax loss will be limited to $3,000, but the rest is not lost. You can carry it over to another year. As always, thanks for listening.